Well, hello everyone, and thank you for watching this video. We are excited to share with you about Kellogg's acquisition and payment audit cycle. Just briefly, Kellogg Company needs no introduction, and the odds are you probably ate their products this morning for breakfast. But just briefly, Kellogg was founded in 1906, and its subsidiaries are engaged in manufacturing and marketing ready-to-eat cereal and convenience foods. And as you can see here, our favorite Frosted Flakes and Rice Krispies. Now, just before we get going, I want to just share with you about the business functions in this cycle, the acquisition and payment audit cycle. What are we talking about? Well, mainly and simply, we're talking about purchasing goods and supplies and paying for those goods and supplies. And so when we get to the acquisition and payment audit cycle, we first come across several significant accounts. And these accounts are significant because they have the ability to misstate and impact financial statements. And so first, we have the cash and cash equivalents. And as we'll see in a little bit, it's because we pay for these products at the end, the cash disbursements, and that is why this is very important. And we also have inventories, both raw materials and finished goods and materials in process. We have property, plant, and equipment. We also have accounts payable, and we will see this. We get there as soon as we have an approval, and we make payment, and then we pay for those payments through the cash equivalents. We also have cost of goods sold, as well as selling, general, and admin expenses. Now, these are the significant accounts that we as auditors need to be aware of and need to be conscientious of as we approach this audit cycle. Now, to tell you briefly, there are 5 distinct activities to the acquisition and payment cycle. First is requisition. This is when you request the purchase of the goods and service. Secondly, the actual purchase when you buy it. Thirdly is getting the receipt and accounting for the goods and services that you've just purchased. Fourthly is the approval of these items for payment. And lastly, you have the cash disbursements in which you actually pay for these items, and it hits your account, and you end up debiting accounts payable and crediting the cash account. And so this should give us an idea of what we're talking about. Now, as you can see, this is a consolidated balance sheet from Kellogg's fiscal year ending December 31st, 2019. And we have here, as you can see, the cash and cash equivalents, accounts payable, property, plant, and equipment, as well as inventory. And we can compare year by year. And we also have the consolidated income statement from Kellogg's statement of income. And as you can see here, we have the cost of goods sold as well as a selling, general, and admin account. And I just want to point out that, the selling expense is a control account, and some of its subsidiary accounts include commissions, travel, delivery expenses, repairs, advertising, and the administrative expense control account also has subsidiary accounts beneath it, and those include supplies, officers' travel, legal fees, auditing fees, taxes, etc. Now, we wanted to discuss the relevant assertions. Now, you might be asking, what is that? Well, quite simply, relevant assertions are any assertions that have a meaningful bearing on whether a financial statement account is fairly stated. And so one assertion is completeness, and this is completely relevant when it comes to Kellogg. Why? Because completeness basically asks, are all transactions and accounts that should be included in the financial statements included? And so here's why we have to be aware of that. It's because Kellogg is in both the United States and the United Kingdom. And so we want to make sure that all the inventory transactions are recorded during the correct periods in the inventory system. We want to make sure that all of the correct inventory is included. And that's why we would perform periodic inventory counts to balance the inventory counts and perform write-offs if necessary. Lastly, we would reconcile all accounts payable statements within AP tracking systems. The second assertion that we want to discuss that is relevant to Kellogg is the valuation or allocation. And the valuation or allocation basically asks, have all the accounts been included in the financial statements at appropriate amounts? Appropriate amounts. That is our concern here. And so we would monitor the utilization of future tax deductions or opportunities regarding undistributed foreign earnings because that affects amounts. We would also verify the reliability of all technical inventory systems, of all processing, transmitting, and storing of information. Again, we need to ensure that there's proper communication between the US and the UK. And lastly, we would evaluate cash conversion days and average working capital year over year for inventory on hand. Now, when it comes to inherent risks, there's always going to be risks, right? And we're trying to minimize it. But here are some of the inherent risks with Kellogg, the Kellogg company. First, they're relying on information technology systems to process, transmit, and store information. Now, we know that information technology and technology in general is not perfect. And so we anticipate mistakes, especially when it's a global company and it's multinational and it's working in multiple nations. And so that is one source of error and risk and faulty information. Secondly, globalization and its impact. Approximately 42% of Kellogg's 2019 net sales were outside of the US, and they manufacture the product in 21 countries and operate in more than 180 countries. I don't know about you, but that is a lot. It's too much. And so it will have impact, right? You're going to have issues with compliance with the US anti-corruption laws, anti-bribery, because you're working in different countries with different rules, different culture values, and different laws. You're also going to have changes in capital controls, right? Currency exchange controls, government currency policies, and that will have an impact on Kellogg's ability to import raw materials and finished products, and that will in turn impact its inventory accounts, which will impact our accounts, our significant accounts, and that is very significant for us. And aside from new tariffs and quotas and trade barriers and price controls, which will also impact due to globalization. Thirdly, we have underrecorded purchases, which would impact our accounts, incorrect write-offs of obsolete inventory, which would impact the inventory accounts. And lastly, we also have the inherent risk of fraudulent transactions. Now, here's why this is so crucial. It's because when you have a volume of transactions, the risk is heightened, and you have employee theft of inventory. Now, more than that, you have also the fear that executives would misuse travel and entertainment accounts and charge them as company expenses. That's why we need to be aware of schemes to classify expenses or reclassify them or misclassify them. And this is why we also have expense accounts included in the significant accounts we look at. Well, friends, we're coming up on the end, and we want to discuss lastly the analytical procedures. And the analytical procedures, through them, we can evaluate financial information through analyzing plausible relationships among the financial and non-financial data. Now, the first set will be the inventory ratios. And so just for example, the gross margin analysis tells us the overall money that the company would have left over after it subtracts from their cost of goods sold. We also have the inventory turnover ratio, the shrinkage ratio, the inventory overhead application ratio, and sales in the last month. And all of this enlightens us regarding inventory, and that way we're able to analyze more accurately inventory ratios and to determine where there's more risk and where we need to do more substantive tests. Secondly, we have the accounts payable ratios. And so the accounts payable turnover, for example, measures the short-term liquidity from the accounts payable turnover to see if Kellogg's is paying off their suppliers and how often they're doing it during the accounts payable turnover period. Now, this is pretty significant for an important reason. And that is because based on this and comparing this to the industry average and to previous years, we can be able to discern what numbers are out of place and what numbers need more direct testing and evidence to be acquired. And then we have the accounts payable and the current liabilities. And so we look at the balance sheet and we see how much they have to pay, what current liabilities they have, We also check the purchases of the returns and allowances and to see if the returns they purchased and the allowances they have of those said purchases. And so, dear friends, this is our presentation on the acquisition and payment audit cycle, and we hope that it's been helpful, and we hope that you have a wonderful day. Thank you.